Hey, hello, welcome back. This is Roger Royce with the 10,000 Startups podcast. I'm a partner with Haynes and Boone in Palo Alto. I do emerging growth and venture capital, and each week we bring you original content on legal issues of interest to startup founders. And this week we're going to talk about various tax planning techniques. We're getting towards the end of the year, so now is a good time to think about some of these things. So we're going to talk about tax planning techniques. We've got Tony Mancini with Frank Rimerman and Company. Thanks for being here, Tony.
Thank you.
Yeah, so Tony, you and I go back a long ways. I was just thinking about this the other day. I think I met you while I was with GCA Law Partners, and it was in the 90s. I know that. Um,
A long
that's,
time ago. I'm thinking 30 plus years probably.
that's like 30 years ago. Can you
Yeah,
believe it? And we're
yeah.
still out here plugging away at it, aren't we? Yeah.
Time
And you've been
flies,
with
right?
Rimerman the whole time, haven't you?
Yeah, I did 4 years at Arthur Anderson out of college in Santa Clara there. And then, yeah, 30, been here at the firm here over 30 years now.
Yeah, that's a lot. And your focus is on corporate tax, I understand. And because you're in San Francisco, Silicon Valley, it's very much, I think you do a lot with technology companies. Is that about right?
Yeah, I'd probably say, I'm going to guess 80, maybe 85% of our clients are in tech space, work with startups. We're a Bay Area focused firm, so San Jose, Palo Alto, San Francisco, and yeah, I started our corporate tax practice, and so that is our base. Our firm's also really well known for individual tax, and so we have a lot of these founders of startups and some public companies to where they are looking at various ventures and things in the space as well. So a lot of different uh, places we get referrals from, but that is our main spot here.
And I know you do a lot with the venture community, and Frank Rimerman and Company is well known in venture capital. And I know you do a lot with tech. And you also do both the tax returns, the compliance, the tax audits and controversy, but you also do audit. Is that right? Your firm?
Yeah, we're a full service firm, so we kind of look at ourselves as like the alternative to the national firm. So audit, valuation, we've got a large accounting services group. They actually specialize on the tech side. So, you know, large venture capital firm funds a portfolio company. We would be one of the first calls to kind of get them set up and then um, you know, go all the way through helping them hire a controller or CFO. And then we typically would pull out.
Okay. All right. Well, let's kind of jump right into it. I know that you are very deeply involved in the R&D credit. And so I guess for our audience, I mean, it is such a huge thing in this valley. Maybe you could kind of set the stage at a high level. What is an R&D credit and who gets it?
Yeah, I'm not saying I'm enjoying being involved in the R&D credit, and I don't know technically if I would be like an R&D credit specialist by any means, but certainly helping articulate risk to clients, I think is a big place right now. And we really didn't have that, since COVID, but there's this uh, allowance for the R&D credit that came out where, you had to be typically be profitable to claim an R&D credit. It's a credit against your income tax. Uh, Several years ago, they came out with an opportunity for startups to claim up to 250,000 of the R&D credit against their payroll taxes.
Mhm.
And so, right out of the gates, companies were able to actually make this a refundable credit. It was, you know, you think if you do, it was a 5-year rule, so you could go for 5 years and basically cumulatively claim, 1.25 million against your payroll taxes. So pretty
Let me
big deal.
pause on that for a second because that's really significant. Because I know when I say tax, a lot of these startup companies say, well, gee, we don't have any income. We don't pay tax. So why do I care? But what you just said was really interesting, a refundable credit against payroll taxes, because
Yeah.
everyone's got payroll taxes, even a startup company, right?
No, and so, a lot of even payroll companies were kind of caught in the headlights there because they were like, how do we do this? You actually you make the election on your income tax return, And then you use that information to fill out this form that you send to your payroll company, and then they're gonna, get it to you. It was a problem for some of the PEOs, right? Because it's under their ID number, so they would claim the credit against the payroll taxes. There'd be the reduced liability, and then they would allocate that refund back to the client. Um, so there's some semantics that had to work through, but it was a pretty lucrative thing for startups. And then just starting for this past year, it actually moved to 500,000.
So it's a
Now
$500,000 credit potentially against payroll taxes. And you said you could take that for
an
five.
offset. So we'll call it an offset. So because it's a dollar for dollar refund. So, or I guess a reduced liability. So if you had, let's say, a $2 million R&D credit in a particular year, you could claim 500,000 of that 2 million to reduce your payroll tax liability.
Yeah. Okay. Now that's a huge benefit. And
Massive.
we have done a previous podcast on sort of the mechanics of that. So I won't get us all bogged down into that. What I want to talk with you about is what your experience has been with it now, because I've been reading in the papers that we have a lot more IRS agents out in the field,
Yeah,
and people need to be a little careful about what they claim.
it's concerning. Um, I think historically the R&D credit didn't get a lot of attention because startups, if they weren't profitable, they weren't getting any kind of a benefit out of that. And you could kind of make the case if you got acquired, maybe there was an asset there for the buyer, but I don't think that ever really typically monetized in the way people thought it might. But in terms of the risk here is that, now they're getting these huge benefits. And the thing with the IRS is because they do have all these agents. I think as of 6 months ago, I did not have one R&D credit audit in the prior 10 years. Um, in the last 6 months, I think we have 5 or 6 going on right now. So I think this is partially in response about a year ago, maybe 2 years ago, the IRS, there was some watchdog group that called out the IRS as kind of behind the eight ball in terms of a lot of these startups that were claiming the credits didn't qualify. There's like the gross receipts requirement. There's, how many years of income, all the mechanics you talked about, you already went through. They found that 15% of the startups that were claiming the credit actually didn't qualify for it. Yet there's no test here. It's like the ERC, right? Where you make the claim and they send you the check and then they ask questions later. So companies were claiming these credits, getting these big payroll tax offsets, and there was really nobody watching. There weren't any audits and things like that. And so we also knew that they had all these agents, and I think these agents are starting to eventually move off the ERC. And so, we're starting to see a lot of scrutiny, and it was expected scrutiny. We work with a couple companies that do nothing but R&D credit, tax credits studies, and they've one in particular, they've kind of notified us that, hey, we're starting to see a lot more attention in this area. Expect some audits, and kind of good for them because I think the way they do their studies, and that's really the thing here is study is a very loose term. Um, so from kicking the tires on whether it makes sense to actually doing a formal study, there's a big difference, and I think there's a big difference in the perceived insurance you're going to get by doing a study or not.
Yeah, so when you say study, it's like you as the accountant, you'll put the numbers on the return and it's on that return, but somebody else who apparently has some technical expertise, and by technical I mean they understand the technology, can go through and can quantify the actual metrics for claiming the credit. And I think what I'm hearing you say is that study is pretty important before you're going to actually take a return position, right?
Yeah, it's not just the study that's important, but it's the quality of the study. And that's where my concern has been. Kind of like you remember like cost segregation when it came out, you had to rely on an expert. You could break the components of a building into shorter lives.
Mhm.
We saw everybody from architectural engineers doing this to property tax appraisers, or quite honestly, people that just liked real estate. It was so lucrative that anybody could say they were an expert. There was no rule there. It was just kind of like, people started busting up buildings into components and getting these great answers. And so I think it's a little different in the R&D area, but certainly when we prepare a return, when most CPAs prepare a return, it's a one page. The credit claiming the credit is a one pager. I think it's two now. Um, and so there's not a lot of analysis that goes into, are your contracts U.S. contracts? Are they foreign labor? Do you maintain all the rights? All those things that go in. There's a lot of questions now about like hosting costs. Hosting costs were always excluded, but now with AI, they're like a huge part of the development. And so the IRS regs have never really caught up with today's technology. Um,
Mhm.
I think even when we had a very competent study, your auditors would reserve 90, I would typically see like a 90 to maybe 75% reserve on the credit.
Mhm.
With no study, they'd reserve the whole thing. Um, and
Well, there
so,
you go. That's why the study's important, right?
yeah. But the quality of the study, again, I've seen a lot of times where they'll come in, what we like to have is a deliverable package. So if you and I aren't here in 3 years for some reason and they get audited, that there's something you can hand over to the IRS. And that's typically their first ask in an audit on the IDR, the information document request. It's please send us a copy of your study. And it doesn't mean that you're going to lose if you don't have one, but when you don't have one, you know, I think that leaves a little bit of a taste in the IRS's mouth of like, okay, these guys have not been, um, you got to produce the documentation in that first request. And if you don't have that, it's going to be a long process and a long administrative process because I don't know too many startups that can pull their CTO or some of their top engineers to be spending time meeting with the IRS. Um,
I'll
you know,
bet.
there's a huge time requirement there.
Yeah, now you said something else kind of interesting about how people thought that this was going to be a real valuable tax asset. I mean, we both do a lot of M&A, and I remember hearing about that a lot as well, that it's going to be something that's going to make the target really valuable in an acquisition. And honestly, I hadn't thought of it till you said it, but yeah, I haven't really seen that so much. And maybe it's because the reserves are so big. Uh,
Well, I think in reality, what happens is the buyer says, "Oh, you haven't documented your credits." And quite honestly, even if we did document the credits in a study, they'd say, "Well, that's not, we're requiring you for your IP. That's just kind of something that happens." But then they'll use the credits when they buy the company.
yeah,
If they will, the net operating losses, which are also difficult to monetize.
Yeah, so the target, it's maybe a little too clever by a half, as they say. I think, the target doesn't really get the benefit of all those tax benefits, but the buyer does.
Yeah.
Let's move
Yeah.
on to, is there anything else about the credit itself? So I want to talk about the deduction. So the credit is, like you said, it's a dollar for dollar offset against tax for a certain portion of increase in R&D spend. And for a company that doesn't want to take the credit or can't or whatever, there's also a deduction, right? That's 174. Could you tell us a little bit about that?
Yeah, they kind of line up differently, but the 174, for I don't know, decades, companies have been deducting R&D. And, we want to have the United States competitive. There's these very favorable rules under Section 174 for deducting R&D. Um, in the TCJA with Trump's tax reform, there was this, I've even seen it referred to as kind of a gimmick, but to help kind of pay for it, it didn't set in until 2022, where 174, if it was US born expenses, had to be capitalized and amortized over 5 years. And if it was foreign, so if you had like an Indian subsidiary doing R&D, it was 15-year amortization period. And it kind of caught everybody by surprise. I think everybody assumed it was going to get thrown out of the law. I know it was a very rough tax season because to tell somebody they've lost, they had a $10 million gap loss, but they had 15 million in R&D and now they're profitable for tax purposes was a tough discussion. I had a couple CEOs admit that they Googled the issue before they got on the call with me. Um, and so it put, a lot of startups in a precarious position. And I know they got close to taking it out of the law, but, interestingly, the Republicans wanted to get it taken out, but then the Democrats made an issue with the child care credit. And then they started referring to the 174 deduction as a corporate tax break, even though it had been in the law. And interestingly, also, is that their own Inflation Reduction Act is the one that increased the payroll tax offset for the R&D credit from 250 to 500,000. So they they were giving it there, but then they weren't going to allow it on the deduction side. And so what you had was, hey, we get a bigger R&D credit, but we may have to use it because now we're profitable because we can't deduct the R&D. It was a very kind of a very bizarre situation. I would envision, because the Republicans have all three arms, that this will be removed. Probably not retroactively, we're hearing, but it should be removed, I think, with the next tax bill.
Oh, okay.
That would be the plan.
All right.
But, when you do run into that situation of being profitable because of the 174 capitalization, it's not just that you're using R&D credits, which require study, but then, utilizing your NOLs, your net operating losses. We need to do an ownership, Section 382 study to make sure those losses are free to use because there's limitations there as well. So a lot of companies were not just bit with a tax bill, but also a lot of professional fees to properly address these issues.
I can imagine. Yeah. So tell me, what is a 382 study for our audience?
So, if you, I think this was put in back, so targets in an acquisition weren't bought for their NOLs. I think there was some auto
And by NOL,
manufacturer,
you mean net operating
net
loss.
operating loss. So, yeah, an auto manufacturer had, say, a $10 million loss carry forward, and the property was worth, the assets were worth 10 million, and they paid 15 million for it. So they were basically buying the loss carry forwards for future tax shield. And so this rule says that, if you've had an ownership change measured by value or vote that's tripped over 50% in any prior 3-year period, it's very complex, but then there's a limitation, and they determined that the limitation on the NOLs, you don't lose the NOLs, but you can only use the NOLs to the extent of the limitation. The limitation is the long-term tax exempt bond rate times the value of the company. And as we were going through COVID, long-term tax exempt bond rates were like 1%. So it was a pretty low limitation if you did trip this. And interestingly, companies that do financings, you wouldn't think that they would have an ownership change, but if you have a down round or if you have a new investor come in, and again, it's a 3-year cumulative test. So if you had a couple of rounds in that period where somebody's, and they only count increases, not decreases, but if you have increases that exceed 50%, then you'd trigger a 3-2 change, and it would automatically limit all the NOLs prior to that date.
Yeah.
So
And that's how I've
it's
seen
a
it come up.
cumbersome calculation.
Yeah, it's the financings. Nobody's thinking about that at all. And
No.
again, startups are thinking, I don't have any net income, taxable income. Why do I care? Well, all of a sudden, then they do, maybe because of this 174 limitation,
Yeah.
right? And all of a sudden, they do care about 382, but it's too late because they did their financing and now they're stuck. Do you know what the long-term rate is now? I got to believe it's still pretty low.
It's pretty low. I think I just looked the other day. I think it's in the maybe 3, something like that. But on $100 million company, that means you can use $3 million of your loss carry forwards. And we had some clients that have really kind of popped here where they're making 7 or 10 million a year. So, and these 3-2 studies are not cheap. I mean, the average, I think, for a national firm, they probably don't touch them for much lower than 80 to 100 grand.
Yeah.
We're probably about half that. But then when you have the limitation on your NOLs, then you're into your R&D credits and the ordering rule. And then your R&D credits have to be substantiated. So there's another study that is going to, be potentially fairly costly. I think on the R&D studies, we used to see them going for, maybe 25% of the credit. And now we're starting to see like an AI approach where I feel like it's very boilerplate template type approach that is untested because, again, we haven't seen the audits yet conclude. But there are firms out there pitching an AI study that's more of like 5% of the credit. And we're kind of waiting to see if this is going to be successful or not. I have my doubts because the IRS isn't stupid. That AI is going to produce a tailored study that's going to fairly articulate whether you meet the rules of technological advancement and the support that goes with it. It's a tall task.
Yeah, it's interesting. As I'm listening to you describe this, I'm thinking about, all those new auditors that are out in the field that the IRS has. And I remember there was when the IRS funding was increased to increase audit activity, there was this idea that, well, if you got nothing to hide, why do you care if you're being audited or not? Well, this is why you care. because I
Yeah.
can see already just the complexity, even if you've done everything exactly, right, beyond question, just to go in and audit all that, yeah, that must be a gargantuan task for a typical tech company.
Yeah, and like I said, we use CTI. They're somebody we worked with for 20 years, very highly qualified. 90% a win with a study.
Yeah.
So without a study, I guess we'll be finding out here soon.
So 90% of the time you can justify.
If you with a full study, if you could substantiate with the IRS 90% of your credit, you should consider that a win.
Oh, I got
Yeah.
you. Okay, got you.
So without a study, or with one of these AI studies, I guess we're going to wait and see. And I do suspect the percentage of substantiation is going to be lower. The concern also is that there's been some recent court cases in the area where, we thought if you had a $2 million study and you're claiming a payroll tax offset of 250,000, well, we'd have to really blow it to not at least meet the 250. But there's some recent cases that have said that if you don't have the substantiation, you lose your entire credit.
Mm.
And so now we're not talking about, well, $2 million credit, we got plenty of cushion to at least not have to pay the IRS for the payroll taxes we used because we were so far over the limit. Now we're talking about losing the whole credit. And so you'd have to pay back the 250, you'd have to pay back interest and likely penalties. And this is a payroll tax, which is one of the few taxes maybe one of the only taxes you would know that they can pierce the corporate veil and go after the officers. Uh,
Yeah,
we
that's
haven't
that,
seen that, but I hate to be the
that's a
worst case
that's a
scenario guy, but
that's a big point. I'm glad you mentioned that. Because yeah, exactly what you said. This is one of those liabilities, that you have to be super concerned about, because like you say, the veil can be pierced, individuals can be personally liable. And people go into companies not expecting they're going to end up with personal liability, but if this gets messed up, they could end up, you know, certainly being there. Hey, let's shift gears with the time we've got. I do want to mention the ERC, the employer retention
yeah.
credit. And this is one of the COVID tax credits that came into effect that a lot of companies claimed. And it's been in the news a lot over the last, well, lately and over the last year or so, because the IRS has been so slow in paying these things out. And most companies, the amounts are small and it's not worth challenging, but some companies have sued for refunds. But what have you been seeing in the ERTC space?
You know, um, a lot of chaos. Um, we got some clients that got paid out, some clients it's been years. I think I mentioned the good news is you're getting interest on that refund. Um, I think if you qualified because of the gross receipts exception, that's a pretty clear one that you should be feeling pretty good. If I was
Can we pause
claiming,
for a second just
yeah,
for the audience? So in order to get
oh,
this
thanks.
credit, the credit for
Yeah.
basically wages paid, but you have to show either a substantial decline in gross receipts, because of COVID shutdowns, or what was the other alternative?
Well, so I'm going to correct you there, and this was kind of a weird thing in the law. The decline in gross receipts does not have to be because of COVID.
Hmm.
You could have had a product liability issue. You could have closed down your company. You could have done an accounting method change. It was said in the committee reports that the decline in gross receipts was just a decline in gross receipts. Didn't have to be COVID related, which, as a taxpayer is a little bit I don't know if that was intentional or not, but they did say it did not have to be COVID related. Now, dealing with the IRS and the audits, they may be pushing that issue that maybe it did have to be, but that's why there's so much uncertainty. But you're right, there was the decline in gross receipts, or there was an impact. They call it a partial disruption from the shutdown orders, the government shutdown orders, and we're even fighting about what a government shutdown order is. Is it county? Is it city? Is it, which qualifies as government shutdown orders? And that's where I think the subjectivity is where everybody drove a truck through.
Mhm.
And so um, we, we worked with another firm, same firm that does our R&D studies, really good process, and we felt pretty comfortable. They've had no issues so far. But I have heard of a lot of issues coming up simply because the people that were doing the analysis themselves were not technically competent. There's a lot of hidden things about controlled group rules. If you're related to other entities, you have to kind of include them in your calculation. A lot of things like that. And I think what we're seeing also on the audits is it's a bit of a training exercise for the agents that they're not very technically competent either. And we know that because they're bringing up issues that are really not in the law or they're trying to deny the claim. And so it's been a bit of a training exercise. I think everybody feels like when you get to appeals, that's when you get, the adults are in the room and you can usually get right to the point of, whether you made a mistake or whether it was a valid claim.
It just as a strategically, when you get in an audit, is that your strategy to get to appeals as quickly as possible, or do you try to
No,
nip it in the bud?
when you go to appeals, that means you have to go through the arduous process of getting through the audit. And it's just very, this is very stressful for clients. I mean, the ERC was incredibly lucrative. We have several claims that are in the millions of dollars. So to have this go on for a year or two, with interest piling up, potential penalties, I think it's very stressful for clients. We haven't, the ones we've done at the firm, we haven't had, any get audited, but we would refer it out to kind of our partner in this. And I think they've got through them fairly quickly, but they have a couple going to appeals where clearly the agent is pushing that, something in the law that wasn't there. So we just had a client got denied because, we put in a claim for 80 employees, and on their payroll return, there was an error. The original payroll return said that they had 67 employees. And just because that number didn't match the detail that we provided, they disallowed the 13. And so now we're responding and saying that the payroll provider was looking at the employees at the end of the period, not the total highest count during the year. But they denied the claim, and so now we're kind of going back and forth. So some odd
Oh my God.
doing this. In hindsight, you think they would have just, there was no questions asked again with these ERC claims. You just amend your payroll return, they send you a check. Hopefully in the future they'll learn that, maybe there should be a few questions asked before they send the check.
Well, on that, you said something really interesting, like the penalties sound like they're pretty significant. So you get the check first. Turns out, and this is a pretty hasty statute that was put together. There's all sorts of uncertainty. You've convinced me of that. So let's say we messed up on it, and now we got a check, right? And then you get audited, and not only you have to give the money back, you got to give back interest and penalties, right? Right. So you're way
Yeah.
worse.
Yeah. And it's crazy. I mean, there was actually a provision where they said, hey, if you think that put in a bad ERC claim, we'll let you keep 20% if you turn in the people that filed the claim for
Oh
you.
my God.
And then, Roger, we had so many levels of updated guidance. At first, supply chain, if you had a problem with your supply chain, that worked. And then supply chain didn't work. And then, port closures worked, but if it had to be a U.S. port, not a foreign port. And so they're really kind of making it up as they go along. And unfortunately, when it's the IRS doing that, they're always going to pick um, the less favorable, way. And then again, that's when you end up in appeals and hopefully not, further than that. But
Yeah, it feels like the legislation over the last since 2017 really has just been a full employment act for service providers, hasn't it? Just created
it's been, since COVID.
since COVID, yeah.
At least in the startup area, I think things were pretty calm before COVID, and then between the R&D credit and then the ERC, there's been a lot of activity.
Yeah. Okay, well, we're at the time here. I want to be respectful of your time. I know this is probably a super busy time of year for you. I want to thank you for being here. This is Roger Royce with 10,000 Startups. I've been speaking with Tony Mancini from Frank Rimerman and Company. He's a partner there, runs the corporate tax division. And we've had an interesting, very frank discussion about the R&D credit, the 174 deduction, 382 studies, and of course, the ERC employee retention credit. So thanks for being here, Tony. And for those of you out in the audience, we'll see you next time.
Thank you, Roger.
Okay, hold on here.